Well, welcome back to Finance Uncut. On today's episode, gold and silver wealth transfer. Okay, so a few weeks ago, I did this video, The Great Depression 2.0, where I was warning about what was happening with Evergrande. And this was before the mainstream media started talking about it. And the title of that video, The Great Depression 2.0, might have been, a bit extreme. However, if things happen with Evergrande that I think could happen, then we could be facing the Great Depression 2.0. And then I followed up with this video, Evergrande to collapse the global economy, where I gave a bit more update, more information about the whole situation. Now, we're also getting warnings. Obviously, Jeremy Grantham's been calling for a market crash all year. But Robert Kiyosaki is now saying that we're going to see the greatest crash in our lifetimes. Robert did a debate with Harry Dent going back probably a couple of months now, maybe even longer. And on his channel, towards the end of his interview, Robert and Harry actually started arguing, and it got quite heated. I was loving it. I was driving on the highway down to the Gold Coast, down to the beach, watching it or listening to it in the car. And Harry was saying, "Look, you need to get into treasuries and government bonds." And Robert's like, "Harry, you're stupid. We've got CPI inflation running high. Look at the yields. You're just losing money. Blah blah blah." And it was fun. It was fun. If you haven't listened to it, go check out Robert Kiyosaki's channel, and whether it's his podcast or YouTube channel, and go back. I think it was a couple of months ago. It might have been longer to that interview. And especially listen to the last 5 or 10 minutes. It was golden. Anyway, guys, I guess this video, I actually think that we are seeing the signs of a collapsing economy and potentially financial markets following suit. So let's dive into it. All right. So in this chart, we've got the 5-year credit default swaps from China, and as you can see, boom. And we're also seeing yields around the world start to rise again. However, just overnight from this recording, which is the 30th of September here in Australia, we have seen yields go back down, so people rushing into bonds. So definitely keep an eye on the bond market to see what it says. Now, I know it's highly manipulative with central banks and whatnot, but watch your space. So iron ore could drop to $70 a ton, says Bank of America. Now, I agree with this, and I actually called this some time ago. Iron ore, when it was above $200 a ton, on my Facebook page. So around the time where I did that first Evergrande video, the Great Depression 2.0, I'd been looking at the Evergrande situation weeks leading up to doing that video. So this is going back probably late July. I started looking into this, and then into August. And, when Evergrande, the largest property developer, they're not going to be building and using iron ore, and that makes up 25 to 30% of the Chinese economy. Just looking at all that, I became bearish on iron ore, and it started falling. And then I identified one of our iron ore miners, one of our large iron ore miners in Australia, and I shorted it, or I bought put options on it. I didn't use spreads. I just simply bought put options on it, and that trade is up about 600% to date when I pulled that trigger, and I put it on my Facebook page. that I did that trade. And so, yeah, that's coming off quite nicely. However, my business partner didn't pull the trigger on this trade, and I did tell him, look, iron ore will bounce back up. The stock will also bounce back up, possibly giving you another opportunity to get into this trade. And it did exactly that. And so, yeah, I'm still bearish iron ore. I still think it's going well below $100 a ton. And yeah, I very short this stock, and it's paying off for me at the moment. So when we look at this chart, I mean, this is ringing warning bells of stagflation. So, and very similar if you go back just prior to the GFC. And this is what Robert Kiyosaki is actually saying is, or was it someone else I listened to, was saying that similar environment, inflation was or CPI was starting to take off, and then all of a sudden we have the markets crash, and that I guess stopped that runaway inflation. And they're arguing that we're probably going to see the same thing now, that we've got this massive asset bubble. Inflation or CPI is now starting to get out of control, and what's way to control that? We'll just deflate the asset bubble. But whether or not that happens, just this chart alone says stagflation. So the economy is sick. So the level of general business activity, you can see which direction that's headed. Where prices, well, you don't need me to tell you where prices are at. You're feeling it in your everyday lives. Yeah, so what's interesting, as I'm sure you all know, the two Federal Reserve members, Kaplan and Rosengren, were caught red-handed trading millions of dollars worth of stock, and they sold their stock. And not long after they sold their stock, well, what happened to the stock market? Now, yes, it's bounced back. It has bounced back a little bit. However, the conspiracy theorists will say, well, now that the insiders have taken their money out, they can taper now. They can allow the stock market to fall. However, here's Jerome Powell's net worth. Most of his wealth is in the equity market, but he does have muni bonds, and he's spoken about that as well. So anyway, I just thought I'd share that. So if we do get a market crash, we're actually seeing the dollar index, US dollar index, Dixie, actually strengthen a little bit. Everyone thought that it would crash and fall. But many of you know, and I've spoken about this before, that Brent Johnson's dollar milkshake theory does make a lot of sense to me. And even though I'm on the inflation trade, I do see that as a potential thing to play out. And so, once again, I've shared in other videos, part of my portfolio, I'm holding a lot of US dollars. Now, a lot of people say to me, why would you do that, Steve? You're on the inflation trade. Why would you hold US dollars? Well, like I said, I'm bearish iron ore. Okay, so I think iron ore is coming down. I think if there is a recession in China, that's going to impact Australia more than most countries. So our dollar is going to become weaker just on that play alone. Yet, if we do have a global liquidity event, a market crash, then there is going to be a run to the US dollar. And even Jim Rogers says the same thing. So I can see the Aussie dollar against the US dollar falling dramatically. Now, Brent Johnson thinks that it's going to go sub 40. So it's sitting at about 71, 72 at the moment. Haven't looked at it today, but last night it just fell below 72. And so he's saying sub 40. So I can definitely see the dollar falling back to, and in March last year it fell to what, 55, 56. So I definitely see that playing out. So I hold a lot of US dollars. So when I convert that over, and here's my play, here's my thinking with this. So I'm holding US dollars. If there is a market crash, then there's some very good miners that are going to get pulled down as well. At the same time, these are Australian miners. So what I do is when the Aussie dollar falls, I convert that US dollars into Aussie dollars. So I'll make a gain there on the currency play. And at the same time, these juicy miners that I like will be hammered down. And so guess what? I'm buying miners on special. So this is a play, and it's not my whole portfolio. It's just a percentage of my portfolio, but it's still quite a large amount. So yeah, I see this playing out, and so the Dixie certainly can get back above 100, possibly up to 110. Some people think 120, 130, 140. Wow, I don't know if I see that happening. But anyway, this is, once again, keep an eye on the Dixie. So coming to Australia and houses in particular. So remember, we've got record low interest rates, guys. All right. So the cost of a mortgage versus median wage is much higher than usual, even with record low interest rates. So you can see this here, thanks to Nucleus Wealth. We've put this chart together. And so we've got record low interest rates, yet the cost of a mortgage versus median wage is quite high. Yeah, it's not at its peak, but it is quite high. The cost of a mortgage versus rent is slightly more expensive. So once again, and this is what we're seeing. So we own a mortgage broking business. We've got 30 odd brokers in half of Australia, down the east coast of Australia, in Queensland, New South Wales, and Victoria. We've been doing this for nearly 20 years. And in the last, since the Cerveza sickness, where the government have thrown, you could take money out of your retirement funds, home builder grants, all these first home buyer packages and offerings, saving on mortgage insurance and all that, have really got people into the property market in the last 12 to 18 months. And we just had a client in here the other day, and they were saying, well, we want to buy because the mortgage repayments are the same as our rent payments, so we'd rather be paying a mortgage than not. So a lot of people are looking at that and wanting to get in simply because, the mortgage payments are similar to my rent. But then when we look at saving for a property, it's never been higher. It's never been higher. And these are all at record low interest rates. Okay. So if interest rates rise even a little bit, we've already got mortgage stress at 41.3%. So 41.3% of all mortgage holders in Australia have a cash flow issue, meaning they have more cash flow going out in housing costs than they've got cash flow coming in. So pretty much they're insolvent. That can't last. So our household debt, now over 3 trillion, home loan debt or housing debt, almost $2.5 trillion. Now, you go, yeah, what's the big deal? Well, the big deal is our economy, our GDP. It's ticked up a little bit, so it's about $1.35 trillion. So you can see our debt to GDP ratio isn't looking too healthy now. And yeah, I mean, we see this chart, and M3 is over 2.5 trillion. So if you can draw a line up further, you can see that it just goes vertical. And really since the early 70s, now a lot of people say when we closed the gold window, that we just became a debt-based Ponzi economy, Ponzi scheme. And I agree with that. The problem with Australia, right, and the risk to Australia is our banks have thrown everything at property. So, almost 65% of our bank's balance sheets are towards residential mortgages. Safe as houses, they say. Perhaps. But this is why you've seen banks in the last 18 months offer mortgage moratoriums, not having to pay your loans back. They don't want a lot of houses going onto the market for sale at once, because you'll see in a second why they don't want that. But they've thrown all their eggs, so the Australian government and our banking system has thrown everything into residential mortgages, and that's why you're seeing them over the last 18 months literally throw the kitchen sink at property. And perhaps they've overdone it and perhaps created an even bigger monster, an even bigger problem that we're going to have to deal with. So if you didn't know, in 2017, APRA, that's our prudential regulator, did a bank stress test. And the scenario was a macroeconomic China-led recession in Australia. So once again, if we're going to see this evergrande situation lead to a global recession coming from China, then Australia, if our GDP falls 4%, and we know what it fell last year, house prices decline 35% nationally over 3 years. Now, remember, early on last year when we were going into the lockdowns, that our major banks were predicting a 30 to 35% house price decline. Now, some say that they said that just to scare the government into basically allowing everyone to dip into their retirement savings to use as a deposit. All these other grants, to buy and build a house, to keep it up. So we don't know, but I guess we'll find out soon. But anyway, so 35% price decline over a 3-year period, and unemployment to hit more than 10%. So this is the kind of limit that our banks are at. So if we hit more than a 4% fall in GDP, price decline more than 35%, and unemployment more than 10%, our banks are now in trouble. They've got some issues. So once again, just keep an eye on this. So income growth for the typical American family has slowed since the early 70s, and it's the same trend in Australia. It's the same trend around the world. And once again, you can go back to the early 70s when we changed from really a producing type economy where we save, we invest, we build products that consumers want, to a financialized economy. Our economy has become so financialized at the moment. And one of the reasons, I think it was Joseph Wang was saying, one of the reasons why we're seeing wage inflation in the US and people, companies not able to find staff, is because you've got all these people that have made such a killing trading both tech stocks and cryptocurrencies and whatnot, that they're like, hey, why would I go work for $18-20 an hour when I'm making tens of thousands of dollars a month trading? And so that's creating an issue there. So we've very much changed our economy from a producing type economy that actually creates real wealth to a financialized economy, which is just paper, debt, as I said before, a debt Ponzi scheme. Now, that's pretty much what we've done, because wages haven't grown. We haven't really produced wealth. All we've done is kept increasing the debt year on year on year and seen asset prices rise. So, this is a trend right around the Western world, really. Okay, so this video is a gold-silver wealth transfer. Okay, Steve, well, you've been banging on about Evergrande and this China-led recession, maybe a depression, maybe financial markets crashing, but what does that have to do with a gold-silver wealth transfer? Well, before we get to that, let's cut to a clip I did from a video earlier this year where we discussed some charts from Ronnie Stoffel's In Gold We Trust report. So right here with the Dow gold ratio, I've said in previous videos that I started buying gold and silver again in 2018. And then the beginning of last year, I stopped buying gold altogether and just loaded up on silver. And one of the reasons was looking at the Dow gold ratio. So, we know that the stock market is severely overvalued, that it's not running on any fundamentals. And with the inflation that is, or the CPI increases that I expect over the coming years, the amount of new currency units, either base or broad, rising, yield curve control, negative real rates, I think are so bullish for gold. So I think gold and silver are cheap at these prices, and the stock market is overvalued at these prices. So once again, you can look at this chart and go back, really to the formation of the Fed, and you can see that gold was low, stocks were high, then gold was high, stocks were low, and then so forth. You can see the changes. And so just on this chart, I think buying gold and silver around these prices, just sit on it for a little bit, and I think I will then trade some of that gold and silver in for more stock. So I've shared this chart in a previous video. However, the house price to gold ratio has ticked up a little bit from here as Sydney house prices have increased and gold has actually fallen a little bit. However, as I said, if we do have this financial market crash, if we do have house prices finally crashing, then this house price to gold ratio is going to fall in favor of those holding gold. Even if gold doesn't go up, if gold just sits where it is right now, but we have houses fall, then this plays out in our benefit. And this is why it's so important to always think of gold and silver, or measure gold and silver in other assets, not in dollars, not in fiat currency. People need to change their thinking, because if they can change their thinking and measure gold and silver in other assets, the opportunities to make significant gains are there to be had. And the Dow gold ratio. So where is it headed? Could it head down to 4 or 5? Now, some say it's going 1-to-1, that gold is going up maybe to 4,000 or 5,000, and that the Dow is going down to 4,000 or 5,000. I'd certainly love that. I'd love that to play out. One, I'd short the market on the way down, and obviously convert my gold and silver into quality assets, quality stocks, and real estate and other assets. But I don't know if it's going to go down that far. I don't know if the ratio will go to 1-to-1. I certainly hope it would. But what I do believe is that we've got financial markets that are severely overvalued, like almost on all metrics. It is at peak valuations, which to me says that the odds are that that market, those stock market and other markets that are severely overvalued, are going to come down at some point. And so I still believe that we are in an inflationary decade ahead. And I'll talk about a commodity boom in another video coming up. $173 trillion commodity boom, folks. It's quite exciting. This whole green energy thing, you're going to see how much inflation this is going to create, or how much societal issues this is going to create in another video that I'm doing at the moment. So it's insane. So even though I think we're going to have a market crash, a financial market crash, and gold and silver might actually fall a little bit like they did in March last year as well. But ultimately moving forward, I am extremely bullish Because what's going to happen if we do have a market crash? You're going to have governments and central banks go full on MMT. They're going to throw the kitchen sink at this, and they're going to pass, every green deal that you can think of, in the name of, saving the economy and, saving the planet and everything else. So keep an eye on this, and just, guys, if you haven't thought about gold and silver in this way, in terms of measuring it in other assets, you need to do it. Trust me, it took me a little bit of time. I had to get my head around this once upon a time. But I've experienced this. It's wealth cycles. I've experienced it. So this is just another chart of the Dow gold ratio going back even further. So where could it go? As I said, some say it's going 1-to-1. Perhaps. I mean, I'd love that to happen. But it's a good chart to look at, because it tells you when you should be overweight gold and silver, and then overweight stocks and real estate and so forth. So it's a really good chart. I really want to encourage you guys to really start looking at this and thinking about this, looking at precious metals this way. And this is just a Dow silver ratio. So yeah, bring on 1980 again. Wouldn't that be great? Gold and silver being at the top of a massive bull market, selling it and then buying stocks that are like trading at 3, 4, 5 times earnings, and then having that bull market over the next 20 years, until it was time to then dump those stocks. When the stock market became overvalued in 2000, and what was gold and silver? That was dirt cheap then. So yeah, think about this, guys. Think about it. Now, I've shared this chart in other videos. So gold versus the S&P 500 and treasuries during crises. So you can go back to the 87 crash, all these different crashes that we've had. Okay, you can see the S&P 500 index. You can see during those time periods how much they crashed. You can have a look at US treasuries, and this is where Harry Dent says, yep, get in US treasuries, cash, all that sort of thing. Well, US treasuries, he says, not so much cash. And then look at gold. So gold performed extremely well during those stock market crashes, and this is that wealth cycle. So, take any, say the 87 stock market crash, and you held gold. Well, the stock market crashed 33%. Your gold went up 5%. Sell some gold, buy some stock. You're buying more stock. So this is what you've got to think about. If you haven't thought about precious metals this way, you need to. It's going to be so profitable for you to do so. I've shared this chart as well. Performance of hedges in market sell-off. So the difference here is this one shows the 72, 74 stock market crash. Well, the stock market crash actually went down 50% in nominal terms, not 39.5. But during that time period, gold, I'd love that to happen again. Could you guys imagine right now if gold and silver went up 126% from here and the stock market crashed 40 or 50%? I mean, yeah, baby. I'd certainly love that one. Short the market on the way down, make profits there, make profits on the gold, silver, then buy quality stocks, quality businesses on sale. I mean, that's yeah. And so I'll put a link in the description to this video that I did a little while ago. Now, this is my story. Okay, so in this video, Wealth Cycles, I share my story. How I turned, what was it, about $68,000 in cash into over $750,000 worth of assets using Wealth Cycles. What is a wealth cycle? Well, in this video, Mike Maloney shares what is a wealth cycle. And it's what we've been talking about, measuring gold and silver versus other assets. And so, to keep things short, basically I took about $68,000 in cash, bought silver in 2008, 2009, wrote it up, 2011, sold it, when a guy came to my office to tell me about US properties, and I thought, oh yeah, that sounds great. Sold it and started buying US property in 2011, 12, 13, 14, so forth. Actually, I don't think I bought any in 14. And bought property when it crashed. And I've shared in other videos that I've been selling that property in the last 12 months. And those properties have doubled, tripled, quadrupled. And I bought those when our dollar was above parity with the US. So now our dollar's at 71 cents. I've made money on the currency play as well. And so, yeah, I'll put a link in the description. If you haven't watched this video, do so. You'll learn about wealth cycles and my story and how it worked for me and how I'm playing this wealth cycle out again. Anyway, guys, what do you guys think? Love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. If you haven't yet subscribed, do so and hit that notification bell so you get all my videos when I upload them. Anyway, guys, take care, and I'll see you again on another episode of Finance Uncut.